Hi, my name's Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's episode. First question is from an anonymous listener. They're both 37, married with one 5-year-old child, both earning around $120,000 before tax, combined super $250,000, 3 properties, 2 investments, 1 home. So former principal place of residence, and then an apartment they bought off the plan for $625, but it's only worth about $500, and a home worth about $1.3 with about $640,000 of debt against it. In terms of other investments, $3.6 million in cash. So that was inheritance received, and a share portfolio around $200,000. Their goal is to grow the net worth to around $10 million by age 50 and live off the investments. And they're wondering sort of what to do with those investments. So there's a couple of also actually, given their experience with property buying off the plan and so forth, they're not that interested in buying property. So, okay, let's have a look at what their net investment assets are. They've got just a little over $4 million of net investment assets. They want to get to 10. I said net worth, but I don't know if that includes the home. I normally exclude the home there. But it's possible though, if they double their money over the next 10 years, 7.2%, they'll probably get pretty close to being there. So that's not an unrealistic goal. They mentioned that the former home, which is an investment property, they plan to sell it within the 6-year CGT exemption window. But then they also say they've got a current home which they plan to occupy for the next 10 plus years. So just to clarify how that 6-year window works is that the window only works if you don't claim another property as your principal place of residence. So these people could continue to claim the main residence exemption on the former home. However, it means they will attract capital gains tax on their current home if they're not going to claim that as their main residence or principal place of residence. It gets a bit muddy, and typically you would claim the property that is going to have the highest capital growth. And so everything else being equal, typically that's the higher value property. I mean, assume that percentage returns are going to be relatively similar. So whether you're going to be able to sell that former home within 6 years and not pay any capital gains tax, and in fact whether that is the right approach, you need to get advice on. But it's possible, but it's not necessarily clear or clearly the way to go. Also, it's really about future investment returns and opportunity cost as well. So it's not just, well, I'm going to keep this asset, maximize the tax-free growth and sell it. I mean, that could be the right approach, but really it's about considering opportunity cost as well. So if you sold the property today, what would you get? Now, I'm not going to suggest you sell in this market, given it's relatively soft in most places around Australia, but I just wanted to mention that off the top of my head. These listeners said that what they probably plan to do is not buy any more property, sell the off-the-plan property, and then just build an ETF portfolio in a family trust, establish a corporate beneficiary, and distribute any taxable income into that corporate beneficiary to soak up or cap the tax rate at 30%. Noting that they earn $120,000 each, so their marginal tax rate's about 32%. So, in fact, introducing gearing, so that is go and buy another investment property, for instance, putting aside the tax changes, which I'm going to talk about tomorrow in regards to how those tax changes impact the attractiveness of investing in established property. But putting that aside, they're probably not in a position necessarily to go and add a lot of gearing anyway. I mean, they could add some potentially. That's a potential option, but not necessarily probably the right approach. I think I would form a view on the former home, which is the investment property. I wouldn't be persuaded too much by capital gains tax. You're going to pay capital gains tax on one of these properties and you're going to pay it eventually. So I wouldn't be swayed too much about that. I'd just really about future investment returns. Same with the off-the-plan apartment purchase. Look, if you don't expect a massive recovery in value, then you may as well just move on from that asset, put your cash flow and energy and money to better use. You clearly take some of those inherited funds and repay your home loan mortgage. And then what you might do, for instance, is borrow against the home loan to the extent that you're comfortable and on-lend that into the family trust. So introduce some gearing into that family trust portfolio, which I estimate after you repay your home loan is going to be around $3 million. And maybe you could, for instance, go and borrow almost another $1 million and invest $4 million in the family trust. And that would be, pursuant to your timeline, your sort of 10-ish year timeline or 13-year timeline to age 50. I think that level of gearing would kind of suit it really nicely. In terms of constructing the ETF portfolio, I would definitely get advice. I mean, if you're going to invest $3 million, $4 million into the market, I think there's certainly a basis for paying for ongoing financial advice to make sure that you're making some smart decisions. It's a lot of money to invest, and even a 1% differential in overall return over a period of 10, 20 years is a huge amount, and multiples of what you should pay in terms of what it might cost you in terms of getting the advice. So look, if you're investing, a few $1,000s or even a few $100,000, I don't necessarily think it's worthwhile paying for advice, but in this situation, it is absolutely worthwhile paying for advice. And I would say the advice is free, the way I would look at it. Easy for me to say because I've got a vested interest. I acknowledge that. But the way I look at it is to say, what returns could you achieve with your level of knowledge and experience? And what returns could a great advisor achieve with their knowledge and experience? And what's the difference? And I reckon the difference is greater than what it might cost you to get that advice. So I guess what I'm saying is it's probably reasonable to expect that you're not going to perform from a risk weighted return perspective, the same returns that what an advisor can do. And so, look, if you like an evidence-based, rules-based approach, find an advisor that adopts that approach so that you still want to minimize overall fees and tax drag and all these sorts of things on the investment, and then can certainly construct a portfolio along those lines. And it sounds like it will do everything that you really want it to do in terms of achieving your goals, getting yourself into a position where, you can contemplate early retirement in your early 50s. But I think that goal is certainly achievable, if you dispose of your couple of investment properties now, or at least over the next couple of years. Then maybe use some gearing against your home into the family trust, and that should do all the work, as well as give you plenty of liquidity and flexibility moving forward, as well as some of that gearing will reduce some of the taxation consequences that the portfolio will produce over the next decade and beyond. All right, thanks for your question. Well, you're certainly in a great financial position thanks to that inheritance. I hope you make the most of it. Okay, next question is from Angela. Angela writes, I'm a retiree and just migrated to Australia to be with my 2 married adult working daughters. I've sold most of my assets, planning to sell my home overseas, and with cash on hand, I'm thinking about purchasing property in Adelaide or interstate. For long-term planning and to minimise tax, stamp duty and CGT, what's the best approach I should take? And there's 3 or 4 options that Angela's listed out there, including buying and using the first homeowners grant and those sorts of incentives, as well as potentially just buying investment property or buying with her daughters and so forth. Look, I'd keep it really simple, Angela. I wouldn't mix up myself financially with my daughters because that can create some challenges and some risks, particularly if they have a relationship breakdown, or if you do something with one daughter, how do you equalize it with the other, if that's what you're of the mind to do. And also from a borrowing capacity perspective, doesn't always suit lenders to have a retiree parent involved in a loan with someone that's at working age. That can get a bit muddy as well. So there's a whole bunch of reasons I'd keep it separate. Look, go and buy a home, probably, because you want that security. And I would spend, as little as possible on that home, which is not to say that, you would go absolutely minimize the budget. But I guess what you're trying to do, I imagine, no, you haven't given me any numbers here, but make sure you're going to earn a decent return on those monies. So buy a home. If you're entitled to first homeowners grant, so be it. And any sort of stamp duty concessions that go along with that. And then any remaining monies, I'd probably get into superannuation, because they're going to be tax-free in retirement. And you've got to work within the concessional contribution caps, of course, but hopefully you can get at least maybe nearly $500,000, maybe maybe over a couple of financial years into super without knowing the amounts, whether that's possible. I mean, certainly I would try and achieve that at least, but I don't think I go and buy an investment property, particularly given the federal budget changes, which I'll talk about more tomorrow. But I just don't think, with no ability to be able to borrow, because Angela doesn't have an income because she retired, no gearing property just really isn't that attractive. And you're not at the right age and stage to gear in any case. So I think I'd just buy a family home to occupy that you're comfortable in, and any surplus monies try and get them into superannuation. But it's not advice, of course, it's never advice in this situation. But in terms of keeping yourself, the best thing you can do is make the best financial decisions for yourself, and ultimately in the long run that will benefit your daughters. So quite often when clients ask me, I want to help my kids, or can I help my kids, the best thing you can do to help your kids is make sure your financial position is as strong as possible. That way in the future, you won't be a financial burden on your children. Burden might not be the right word here, but you know what I mean. And you put yourself in the strongest financial position possible, in terms of your estate and leftover monies to help your children. You maximize those probabilities as well. So good luck with it, Angela. I hope you do well, but that's sort of the approach that I would think about employing. Okay, some more questions from another listener. A bit of random questions without too much context, but maybe I can talk to them anyway. First question is, should a person enter into a transitional retirement arrangement when they're 60 years of age or not? So there used to be transition to retirement means you can draw up to 10% of your super balance a year whilst you're working. You still need to meet your condition of release. You still need to be 60 years of age, because normally between age 60 and 65, the only way you can access super is if you permanently retire from the workforce. But transition to retirement was brought in to help people kind of, as the name says, transition into retirement. So maybe work part-time and still be able to draw a little bit from super. There used to be some taxation benefits associated with doing a transition to retirement pension, but there's no benefits at all, taxation benefits now. That changed quite a while ago now. So no, my answer would be no, you wouldn't start a transition to retirement pension unless you really needed the money. So unless you're in that situation where you feel like, well, I want to reduce to 3 days a week, but the money I will earn off 3 days a week isn't enough, so I need some money from super, then you might consider doing that. In that situation, by the way, it might be better to retire, say today, Tuesday, and then reapply for your job on Monday so that you can start a full pension, because then your super will be tax-free. But, whether your circumstances allow you to do that is up to you. Another really open-ended question. What's the required super balance that a person should have at age 60 in order to be able to live a modest retirement for another 25 years? I did a blog on this last couple of years, I think, and I ended up, in order to spend $120,000 a year, a couple needed about 2.2 or 2.3, around about that amount, I'm pretty sure. So if you're single, it's not going to be exactly half, but maybe it's sort of 60% of that amount. And if you're going to spend less than that per annum, then of course the amount is less also. But you can go and find that blog and you can probably extrapolate, roughly what your balance should look like, but it should be pretty healthy. Another question, if one has an investment property that's fully repaid off, so no loan, reaches age 67 years of age, is it a good time to sell it to their own sons/daughters before or after retiring age 67? Well, selling a property to children's not going to change your asset test. So in regards to Centrelink and age pensions, so there's no considerations there. It's probably really just going to be capital gains tax consequences. And I guess that really depends on, what the value of the asset is and what those capital gains tax consequences are. I would say that you'd probably want to get that money inside super. I'm not sure about selling to your kids. You could do that. But in terms of if you've had an ungeared investment property, what should you do with it? Well, eventually you want to try and get as much money inside super because that's going to be most tax effective. But yeah, I don't really have enough context to really answer the question. And the final question is, what are the tax implications for children if one sells the investment property to them or should not sell to them? Well, I mean, the tax consequences aren't that different to buying an investment property from a third party. They've obviously got to pay stamp duty on the transfer, and then they're going to have to pay capital gains tax, and they would have previously got negative gearing. Of course, as if the law is enacted, they won't get that. I'm going to talk about that tomorrow. But look, there's some pretty broad questions there. I'm sorry I can't give you more specific answers, but hopefully that gives you a bit of an idea. Transition to retirement used to be attractive because, as I said, there used to be some unique taxation benefits. There's no taxation attraction to a transition to retirement. They certainly tightened those loopholes. So now it's really just a case of practically whether you need to draw the money from super and whether you're still working or not. But all the best. Okay, next question is from Chris. This is an interesting question. What would you focus on if you were 37, paid off your house in Western Australia, which has a value of $850,000, $50,000 in the high interest saver account, first child on the way, wife has no super and will stop working for a while, she's self-employed. I'm making $140,000 a year, most of it going to savings except for everyday living and unforeseen costs. We like taking a holiday twice a year. I'm considering buying investment property in Melbourne, but not confident on pulling the trigger at the moment. Would need a good buyer's agent as not familiar with Melbourne, but it seems undervalued. Look, I think prior to the federal government tax changes, which again, I keep saying, keep repeating myself, I'm going to talk about tomorrow, I would have probably said you're 37, long runway, should include some gearing, go and buy yourself an investment property. Anyway, I'm going to talk about it tomorrow, so I don't want to give away tomorrow's episode. But sounds like you're really good at cash flow management, Chris, because you got yourself 37, you got yourself into a position where you've got no home, and you said most of your income goes towards savings. Excuse me. So cash flow management's the key, right? Whether you have gearing or not, if you're a diligent saver, and, I mentioned this before, but, I was watching a video and someone was saying, if you invest 30% of your income for, a couple of decades, the outcome is extraordinary. All you have to do is just put that into ChatGPT or Claude and ask it, if I invested 30% of my income for the next 20 years and it compounded at 7%, what would the end number be? You'll be really surprised about how large that number can get. So you don't need any fancy strategies, a lot of gearing, a lot of risk, all these sorts of things. You just need to really stick to the plan and keep investing no matter what. I just saw a question from a client yesterday, in fact, where they're thinking about doing some renovations and they're thinking about pausing their regular investing. They don't need to do that, but I think it's just the mentality of the focus to, prioritize repayment of non-tax deductible debt. That would be not the worst thing they could do, but it certainly wouldn't be ideal. The secret to building wealth is just disciplined approach to doing it consistently, investing consistently, and having a value aware asset allocation. So buying assets that are attractively priced and doing that on a regular basis. And if you do it consistently over a couple of decades, you'll be astounded at the results. But the reality is not a lot of people can do that. Not a lot of people stick to the plan. A lot of people get spooked. A lot of people never get around to it. A lot of people aren't great at managing their cash flow or, peeling off those savings every pay packet to invest. And so what's simple is not necessarily easy. Simple to understand, not always easy to execute. And especially in the first 5 to 10 years, especially first 5, you won't feel like you're making any advancement whatsoever. But in the last 5 years of that investment cycle, whether that's 10, 20, 30, 40 years, the last 5 years, it'll be outstanding. So, Chris, what would I do if I was in your situation? Well, as I said, I'm going to talk about investing in property tomorrow. So I wouldn't do that. Shouldn't probably surprise anyone that I'm giving away the outcome to that episode tomorrow. But what I probably would do is regular share investing. If your wife is self-employed but not going to work for a few years, you might do that in her personal name. If she's self-employed and she's got some entities established, like she's got a company, a family trust, then you might do it in the family trust, for instance. And you might even introduce some regular gearing involved in that as well, given you don't have any debt and you're 37, so you're still pretty young. And you could do that in two different ways. You could, say, invest, I'm just going to pick a number here, $5,000 a month of your own savings and $5,000 a month from borrowings. And so invest $10,000 a month in your wife's name. Alternatively, what you could do is you could have all the gearing in your personal name. So invest $5,000 a month using geared funds in your name, and then your savings, $5,000 a month in your wife's name, so that you kind of get the negative gearing associated with the share portfolio. And then what I would do is see what happens over the next couple of years with these tax changes and negative gearing. But if negative gearing was a thing now, like we know proposed changes, then I probably would say go and buy an investment property. So I would say you want to keep that up your sleeve, because I'll get into that tomorrow. It could change in the future, and you don't necessarily want to exhaust all your borrowing capacity into the share market today. So I'd do it slow and steady over the next couple of years, with still the flexibility to pivot into an investment property in a couple of years' time. But put that money to good work. At the moment, it's in a high interest savings account. It's not earning very much. You're never going to get rich earning interest. You really need compounding capital growth. So get it into a diversified ETF or a value aware kind of ETF portfolio. I did an episode on that a couple of months ago. Get it working hard for you. Start as soon as possible and stick to the plan and stick to regular investing for as long as you possibly can, with as much discipline as you possibly can. And I think you'll be really surprised about the results. But good on you, Chris. You're obviously in a great position, great at managing cash flow. That's more than half the battle won already. Okay, next question is from William. It's a pseudonym, not his real name. Probably didn't really need to know that. A really long email, but essentially William's in a really good financial position income-wise, about 160,000, earning about 160,000, doesn't have any debt, strong soup about 230. How old is William? 34. More than 300,000 in cash savings, 220 in ETFs, and potential support from family in the form of the bank of mum and dad to go and buy a home. And Will's partner is early 30s, so similar to him, earning 100 to 120. She's a saver, has cash in the bank. They haven't combined finances. And he's been watching Perth prices over the last 5 years increase considerably, and kind of bit of anxiety and FOMO about not getting into the market sooner, and wants to implement, what I talk about in terms of buying your forever home as soon as possible. But to buy mostly land value, he needs about 1.6 to buy in a location where he'd like to live, and thinks it's also primarily a good investment. But his borrowing capacity is about $1 million based on buying for investment purposes, which means that he'd need to kind of sell, probably most of his ETFs and get some help from the bank of mum and dad. So doable by himself, but his thoughts are, whether he should buy property together with his partner. It's a really, really challenging question to answer, but I would try and, you've done the hard work of building a ETF portfolio, so it'd be shame to sell it. I mean, it's not the end of the world. If the girlfriend wasn't in the picture, I would sell the ETFs, buy a really great property with some gearing, and use it as your home. So even though make the application as an investment loan to extend your borrowing capacity, which is what William's saying, but then change your mind after settlement and go move into the property. And then you can go and tell your lender, okay, I've moved in, you'll provide a rates notice or something, and then they'll change the loan from investment to home loan. And so it's a kind of way to navigate, maximize your borrowing capacity, but still get a home loan at the end of the day, and then still not pay CGT. And then, of course, if you want to move out in the future, you can use the 6-year rule. So that's all doable, but it would be kind of a shame to sell the ETFs. And imagine, say, in 2 years, if you did that in 2 years' time, then you ended up getting married and you think, well, we should have combined finances sooner and I would have still had my ETF portfolio. The other thing too is if you do combine finances and it doesn't work out and you keep your ETF portfolio, at least you've got other assets to kind of fall back upon. So I think I would be inclined, and this is going to be a bit of a challenge to kind of get your head around, I think I would be inclined to have the conversation with the girlfriend about combining finances, but do it in a way that you're co-investing rather than combining finances as a domestic couple. You're co-investing as I was going to say friends. I don't know if I'd pitch it in that way, but co-investing as a couple. So keep it as as arm's length as possible. And what you might want to do is put together or get a lawyer to put together a binding financial agreement. And the binding financial agreement is just a legal agreement to say, look, we're both going to buy this property together. We're both contributing X, Y, and Z. If our relationship is dissolved, we're going to take X, Y, and Z out again, and we'll split the difference of whatever we've accumulated, either accumulated or decumulated, lost during that time of co-ownership. And then just put some really strong rules around it, in a sense, to say, look, let's go in this eyes wide open. If it doesn't work out, we're going to walk away with our share. And I think nothing ventured, nothing gained. You never know. I mean, life's got full of surprises, of course, but at least, and I would do that if that allowed you to preserve your ETF portfolio. So if you could just combine incomes and increase borrowing capacity and then be able to buy the property, albeit with greater debt, can then at least use that combined purchasing power together and preserve, other assets and cash buffer and the ETF portfolio and those sorts of things. Now, if that didn't work, I'd probably jump into the market and buy a really great asset. And I would probably do that either way today, like, knowing that obviously the taxation changes, investing in a home starts to become really attractive. And even though the next couple of years might be a little bit quiet in the property market, you can never time these things. And if and when, those taxation changes were to reset, maybe in a couple of years' time, that's when it's likely to kick off again. But in the meantime, you're, okay, the interest isn't deductible, but you're not paying any capital gains tax either. And that with a bit of leverage, it could be a great investment opportunity, particularly if you're of the mind to, live in Perth long term, if it's not only to accumulate wealth, but also, to have a home that you're living in. But I think I would approach it almost like you would approach co-investing with a friend, like a platonic friend or a sibling or something like that. Put some really strong rules around it, discuss everything up front in terms of how's this going to work, how's the cash flow going to work, what happens if our relationship dissolves, have all those conversations up front so that no one's caught out at the end of it. And look, good luck with it, William. It's an important decision, but getting into the property market as soon as possible, certainly in the long run, tends to be the best approach. Whether it's the best approach in the short run, no one really knows in terms of timing. And because no one really knows, you've really just got to focus on those long-term outcomes. Okay, I'm powering through the questions today. Next question is from Jay. Jay's received inheritance, $300,000, wants to spend $50,000 on a holiday, leaving $250,000 over to invest. What should I do with it? The home loan's $200,000, so they were thinking about repaying the home loan for $200,000 and putting the remaining $50,000 in super. They're both 45, 2 kids, 18 and 15, both living at home. One still private school fees, the other one is at university. The family income $275 with a surplus about $18,000 a year. As said, the home loan's $200,000. The home's worth 2.7. There's 3 investment properties, all with sort of reasonable levels of gearing. They were purchased in the last couple of years. Combined super 430 and some ETFs, and they've got some cash in offsets. So they've got quite a bit of cash. So I think what I would do, because you're 45 and assuming you're not going to retire for another 15 years, you've got the 3 investment properties, but look, I haven't looked at them, but the locations don't stand out to me to say, oh, these are going to be fantastic. And they might be, right? So don't take that as advice, but that's my initial impression. So I think what I would do is do some debt recycling. So I would repay the home loan of $200,000, but then I'd probably progressively draw that $200,000 back out again as an investment loan. So maybe even repay the loan and then rewrite the loan to be an investment loan or whatever you want to do. But essentially, yeah, sure, get rid of the non-tax deductible loan, but I'd actually add some gearing outside of your investment properties and in addition to your super. Your super's okay, but it's not killing it. Of course, you'll put another 50 grand in there, and all your surplus income should probably go into super as well. But I'd add some gearing into ETFs. Keep it pretty vanilla, I think. I'd gear into some diversified ETFs, maybe even into some internally geared diversified ETFs. Maybe not initially, but if the market was to correct, so if there's a 20% sort of reduction in price, then you might introduce some internally geared diversified ETFs as well. But I think I'd be inclined to do that, as opposed to what you're suggesting is just repay the home loan and do nothing. In that regard, you are still looking at your numbers, you're still pretty reliant on your property investments to produce some pretty good outcomes over the next 15 years. They could do that, but I always like to have a plan B. And my plan B in your situation would be an ETF portfolio seeded with some debt, and then holding that portfolio for another 15 years. You would hope that, the value is going to probably triple over that time, potentially. So maybe it gets to sort of 500,000 or 600,000, still with 200,000 of debt. It's still something that's still contributing to your overall investment asset base. Having said that, I should still acknowledge you've got a reasonable amount of investment debt as it is, almost $2 million of investment debt. So you're pretty highly geared. So that's the only caveat, is that, would you be comfortable with that level of gearing? Is it still affordable? All those sorts of things. And look, just watch those investment properties you've got. The performance of those properties over the next 15 years are fundamental to your strategy. And so be open to the fact that maybe not all three are going to work. And the sooner that you can pick which one's not going to work and divest of it, the better off you will be, because you don't want to hold these three investment properties for 15 years and look back and go, well, actually, we're no better off. Again, I'm not saying you're not going to be better off. I'm just saying they're not necessarily prime locations. Okay, so I might leave it there for today. Tomorrow I'm going to talk about, is established property still worth investing in given the federal budget taxation changes? And what could the future hold? And what should we do in the interim while there's a reasonable amount of uncertainty? So I think a pretty good one tomorrow. So hopefully you can join me for that one. Until then, bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.